Wholesale electricity prices are incredibly high. How it may help or hurt our major power companies.
These companies run a gentailer model, so they hedge a lot of the expected load that they get and leave a little bit of extra load to cover for these sort of situations, but this is quite an aggressive situation relative to a normal winter cycle.
Hydro lakes are at record lows and gas supply is falling short, sending the wholesale price of electricity to new heights. It hit above $800 per megawatt hour this week. The last time it rained properly to fill our hydro storage lakes was 4 months ago, in mid-April. Dams in the North Island are 32% full compared to average for this time of year, and dams in the south are 61% full. So supply is low, but electricity demand is increasing. It was up by 2.5% in July this year compared to last year.
I've not seen it that bad. These are unprecedented type prices, so if the market's right, then we're in a state of some distress.
That's leading some manufacturers to shut up shop, with OG Fibre Solutions announcing the potential closure of its Auckland paper mill due to high energy costs. It follows Winston Pulp's 14-day shutdown of 2 of its central North Island mills. Meridian Energy has already asked the Tiwai aluminium smelter to cut production, reducing total electricity demand across the country by 4%. Meridian is only contractually allowed to ask Tiwai to do so 4 times over 20 years, so this is significant. Meanwhile, Manawa Energy just announced a surprise shock to earnings due to the repurchasing of electricity at extremely elevated prices, and a retailer it supplies to defaulting on its contract. All 4 of the major power companies are reporting their financial results this month, where just how much this situation is affecting them will be revealed. Grant Swanepoel is Jarden's energy analyst. He says some gentailers may be managing this better than others. Grant, thank you so much for doing this. Always good to see you.
Maddie, always good to see you too.
It's a bit of a complex picture, this power industry right now, and I know that our listed power companies, there's no direct winners and losers, but can you paint the picture for us about who benefits most and least?
Well, it's really around who's got a bit of gas and who thought they would have some gas at this point in time. So you've got Genesis, which had its coupe cut back and means that it's running its big unit 5 at a lot lower pace than it normally does. But you talk about winners and losers. Well, Genesis has got all 3 Rankins up and running, so they're using a lot of coal at the moment. So it offsets some of that risk. So Genesis appears to be okay from that perspective. A bit more complicated when you talk about the others. You've got Contact, that at least has gas storage. So while they might be short gas over the next 12 months, they've got the ability to use a lot of gas at the moment if they need to, and they are running their Taranaki combined cycle plant quite aggressively. Not as aggressively as they'd like to, but quite aggressively. And they share about 25% in that TY demand response contract that Meridian's benefiting from. So Meridian would normally at 60% lake levels be struggling a bit, but they've got that big demand response that they've pulled quite aggressively. It's a level 4 demand response that gives them some respite to these higher prices. So they might be okay coming through it. And then you've got Mercury, which I suspect is probably struggling against a 30% dam levels in the North Island. But Mercury are really good at risk mitigation. So the downside for them is probably limited because of their risk mitigation strategies, but they're probably the ones hurting the most out of all this, other than Manawa, which came out with a profit warning.
What are you expecting to see across all of their earnings? Are we expecting it to be higher or lower across the board, and how much will this situation actually play into that, or are there other things that may cover it up on the top line?
Yeah, well, there's a couple of companies that are actually got one-off or new generation coming on, or TY contract changes that are going to have material uplifts to their earnings. So you take Meridian, they're adding about 250 million to their earnings from a TY contract change. So there was some nice, decent momentum coming through on their earnings front, even if there is a little bit of hurt through this current crimp on the wholesale price recovery. Contact's also got Tahara and Te coming on over this coming year, so they've got a good 150 million guidance uplift on their numbers, so they've got a bit of momentum coming through. Genesis had a torrid FY24, and their outlook for 25 is for decent earnings growth as well. So they're all right, even if there is a little bit of hurt coming through. It's Mercury that for the first time in 3 or 4 years hasn't got one-off or new benefits coming through to enhance the forward-looking earnings for the first time, and potentially could post a number that's slightly behind this year's earnings. So they all have good momentum behind them, except for maybe Mercury.
With wholesale electricity prices where they are right now, Grant, is there any positive price effects from any of these power companies?
It's very hard to tell because these companies run a gentailer model, so they hedge a lot of the expected load that they get and leave a little bit of extra load to cover for these sort of situations. But this is quite an aggressive situation relative to a normal winter cycle. So it's hard to tell how they've hedged or haven't hedged through the cycle. But I think Genesis are probably well positioned to make some money once we've moved through this cycle or this winter period, because they do have the ability to run those Rankins with aggression. And I think the market is not too concerned with coal burn at the moment, because we know we need it.
We've already seen some manufacturers reduce demand on the system in the case of Tiwai because they were asked to by their power supplier, and others because they can't afford to. What do you think this means for the sector if we start to see more manufacturers pull out of the system? How much could that reduce electricity demand by?
This is an issue. I think it is a short-term issue that we'll get through. And I think companies that can pull back if the cost of electricity is meaning that they're not making a return on the products they're producing, that they should be doing it when prices, if they haven't hedged their generation, if they haven't hedged their electricity bill, while we have $800 to $1,000 prices. But when they normalize again, and let's not forget, through 2015, 16, 17, wholesale prices were well below long-run numbers, and C&I customers were getting costs well below what the residential customer was paying. I never heard anybody complaining back then. So now that you're pinging on the other side, suddenly they are complaining. But let's go back to the root of the problem. The root of the problem is a lack of signals. So the TY deal took so long to take place that you couldn't commit to new builds because you didn't know whether TY would be around or not be around, because the previous government had set a aspirational target of 100% renewable in the electricity market by 2030. Even though they never really walked away from it, they still left it as a threat. It meant the gas industry couldn't get on with it. It meant that the electricity market couldn't get on with creating a capacity solution that allowed for gas to be around for longer. So a lot of the issues you're facing now are outside the electricity industry's domain, and maybe they're going to be unfairly pinged for it. But you know, it's just where prices are right now, and I don't think C&I is going to have to face this sort of dilemma for more than a few months, and then we should have a more normalized market developing, for next year.
What about renewables, Grant? All of these big power companies are spending billions of dollars on these forward-looking wind and solar renewables projects. Have any of them come online, and when should we expect them to help out this current situation?
Well, we have quite a few coming online. So this coming year, we've got Harapaki from Meridian coming on. It's just been turned on a month or two ago, into commission a couple of months ago. You've got Tahara, which is already on, running a little bit soft at the moment as they fix a little rattle in the system, but should be at 153 megawatts, which is a big chunk of extra juice. You've got Te Huka coming on end of this year, and a couple of little solar projects coming on at the back end of this upcoming financial year. So there is quite a lot of generation coming on. The problem is the gas shortage means that even when, in FY24, there was about 5,500 gigawatt hours of thermal being produced. Over the next 12 months, because it's extra renewable, lets me cut back to about 3,500. So it's pushing gas out. But even at 3,500, it's enough of a demand on the gas market to mean that you're worrying about the fuel supply keeps wholesale prices up. Into the following year, as you get this extra 1,000 gigawatt hours expected to come on from renewables, the gas market is pushed down to a more workable level of about 2,000 to 2,500 gigawatt hours, which means you no longer have the gas industry hurting the wholesale prices as much as they are for the next couple of years. So it's going to take 18 months to 2 years to work the gas industry problem out with renewable build coming on, but there's enough renewable coming on that we are working towards the goals that we set a few years ago of probably getting to about 90-95% renewable in the next 3 or 4 years.
So this situation currently with high wholesale prices where they're at, it's not about 18 months until we might see some relief. Is that what you're telling me?
No, I think in the next 18 months you will see, certainly not, that's $800 to $1,000 level, relief will come pretty quickly as soon as we move out of this high demand period of winter. As soon as we get another water bomb, etc., we will move out of it quite quickly. For the $200 level wholesale prices that we've seen over the last 18 months, we're probably not going to get much respite on that for the next 18 months.
If wholesale prices coming down relies partly on these renewables projects coming online, but we know that some major power companies, those projects haven't actually received FID, final investment decision status. So how much do we need those decisions to be made to help out?
The answer is wind resource consents are taking longer than people were expecting. And there's not a lot of wind that has been consented. There's a lot that's in the consenting process. So going to FID is taking time, and it takes 2 to 2.5 years to build wind. So once you've gone to FID, you still got to wait 2.5 years before that juice comes on. What is easier to consent is solar. So we are seeing a lot of solar FIDs coming up and getting to FID because they can come on within 18 months. So the FID process, or what the resource consenting process, is probably holding up some of the speed that companies want to go to FID. But there's enough coming on that in an orderly process we should have the market back in balance by 2027.
Okay, if they do decide to go with all of them, how much of a risk is oversupply and us eventually having the opposite of this situation, too much power and super low prices?
I think oversupply becomes critically negative to investors when this gas crisis is less of an impact on the market, which I only foresee in about FY27. So if you're getting closer to a balanced market with a balanced fuel supply into it, the market is quite sensitive to small changes in supply relative to demand growth. So I do see some risk of oversupply and being sustainably oversupplied for a few years from about FY28 onwards.
So we could be looking at a situation, Grant, in about 3 to 4 years' time where investors actually see earnings drop for these power companies because prices are the opposite of where they are now.
You did right in saying power prices are probably coming down, but let's not forget these are gentailers for a purpose, and what they do is they contract out longer terms than just what's right in front of them in terms of retail customers, C&I customers, and just generally they keep their hedge position for what they're selling in further beyond just the short-term wholesale price. So investors will still do all right out of them, and hopefully the downturn into an oversupplied market isn't too extended to create a hole in their earnings sometime in the future.
There's another risk right now, regulation. When a system has all of these questions being raised around it, it kind of looks like from the outside looking in that the system may be broken. We know the Commerce Commission is looking into any industry where situations like this are occurring. They're about to finish one report. Do you think energy companies could be the next one to draw a spotlight from regulators?
I think politicians will always jump over the opportunity to get a good soundbite out of helping consumers with elevated pricing. Now, retail customers generally don't have their prices changing too materially. C&I customers do, particularly those who haven't put a contract in place. So most C&I customers would not be paying $800 a megawatt hour because they'll have contracted at $130, $140, whatever the price point is, over a medium-term period. So I think that you're trying to protect those that haven't hedged, and to regulate a market, you end up breaking price signals that stop companies from committing to building into the future. So you actually open a big can of worms if you want to start playing around with capacity pricing without a capacity market having been created. So while I think there's going to be a lot of talk about regulation and how we help the poor C&I customer, and I'm sure there are tweaks that could be done to the system, I see it's very unlikely that you make material changes without causing long-term negative impacts on the ability to build a renewable platform into the future.
Well, as we know, we are moving into that clean energy, renewables type future. The power companies are spending billions of dollars to ensure that we get there as soon as possible. They may get crucified for this question, Grant, but do you think it's time we had a conversation about nuclear and its potential role here?
And I don't want to go there.
You don't want to go there?
No, I don't. I don't have any answer to that question, because it's a political hotcake in that I personally believe nuclear is a good science solution to a lot of people's problems, but in a country that has fault lines, maybe it's just too high a hurdle to get the general public around. Never mind that the word nuclear is probably a word that people have more fear than the reality of the science behind it. And a lot of what goes on in New Zealand is driven by sentiment as opposed to science. So nuclear is a conversation I don't think New Zealanders are going to have.
Thank you so much, Grant. Appreciate
Thanks, Maddie.
it always.
Thanks for your time.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.